Ever feel like you're just a pawn in the financial game? If you have damaged credit, you might think you're just barely moving forward while others are leaping over you or flying across the board. It's hard to feel like you're making any progress at all. And sometimes you simply aren't. One of the ways to make progress against your debts is to consolidate them. When you consolidate, you use a new loan to pay off all of your other debts. While this can simplify things, the real reason to do this is if you can get a lower interest rate. With a lower interest rate, you're putting more of your payment towards the principal instead of paying interest. That extra principal payment is the key to making significant progress. That's the combination play that can help you capture your debts and pay them off. But if you have a damaged credit score, you might think no lender would approve you for a debt consolidation loan. That is a popular misconception. The truth is that your credit score may not be the most important thing that a vendor will look at. So let's walk through the ways that you can still get a debt consolidation loan, even if you have damaged credit. More and more lenders are ignoring that 3-digit credit score number in favor of deeper algorithmic data. That credit score is calculated by the credit scoring agencies like FICO or VantageScore, using the information in your credit report. For years, lenders have been looking at your credit report and designing their own credit scores. They are also looking at non-traditional information that isn't in your credit report. The biggest new source of information that they are using is your bank account data. Credit files are snapshots of your credit situation that are weeks old. Bank data can show them your affordability, your cash flow, your other bills, and can do all of that up to the day of the application. So the first insight is that you should not worry as much about that 3-digit number. You should worry a lot more about recent payment history, your average checking account balance, and your debt-to-income ratio. That debt-to-income ratio might feel like the rub. If you're looking for a debt consolidation loan, it means you have debt, and you might have too much debt. A lot of lenders will look at your current debt-to-income ratio and immediately deny you, but not all. There are lenders who offer to pay off your creditors for you when you use one of their loans to consolidate your debt. Because these lenders know that this new loan will go to pay off your other debts, they can see that it won't make your debt-to-income ratio worse. That should make it easier to get approved by them, especially if you have a recent history of paying all those loans on time. They will be able to see that the debt consolidation loan won't make your situation worse and will almost certainly make it better. Most people use debt consolidation loans to pay off credit card balances that have gotten out of hand. In those situations, it makes sense to give a little attention to your utilization. Your credit utilization is the percentage of your available credit that you are currently using. If you have a $1,000 credit limit and your current balance is $900, your utilization is 90%. High utilization makes lenders very nervous. To them, it looks like you're living on a knife's edge and could default at any moment, but that may not be your situation at all. If you can lower your utilization a little bit, that could significantly improve your chances of landing that loan that you need. There are a few strategies for lowering your credit utilization without coming up with extra money from your monthly budget. First, you can pay your credit card bill twice a month instead of once a month. Even if you aren't paying any more, your monthly average utilization will go down. Second, stop using the card for your day-to-day purchases. Credit bureaus calculate utilization based on your total balance when it is reported. That would include recent purchases, even if they haven't hit your monthly statement yet. Pulling those purchases out and using a debit card can lower your utilization. You might miss out on a few credit card rewards, but the focus is preparing your finances for getting the debt consolidation loan. For a few months, that will be far more important than getting a few credit card points. Third, ask your credit card company to increase your credit limit. In the example above, if your balance remained at $900, but you can get your credit limit increased from $1,000 to $1,500, your utilization drops from 90% to 60%, and your balance hasn't changed. Lenders these days will check your rate using a soft credit check. That means applying will not impact your credit score. Shopping around to several lenders can ensure you're getting the best rate you can get, and it won't hurt your credit score. There is no harm in checking, even if you don't plan on taking the loan. You should always check with several lenders, especially if you have damaged credit. Each lender will have a different algorithm for approval. You might be denied by one only to receive a good offer from another. As you are working on some of these strategies, check your rate periodically. At the Yukon project, we've tried to make it easy to check your rate with several lenders. If you go to our marketplace page, you can apply to any one of our featured lenders. Behind the scenes, we will check your rate with up to 40 other lenders. Our partners use a soft credit check, so applying won't hurt your credit score. We will show you all of your approved offers so you can get a good idea of what you should be able to qualify for. Just because you have damaged credit doesn't mean that you can't get a debt consolidation loan. The key is understanding how the system works so you can make sure that you're using the system to your advantage. And don't be a pawn in the lender's game. Be the queen that checkmates your debt. If you found this information helpful, please like this video and subscribe to our channel. Your support doesn't cost you a thing, and it helps us out. It tells the YouTube algorithm that this is useful information, so others can find it. Good luck on your debt-free journey. Thanks for watching.